In this episode, I'm going to walk you through my recent trade in BlackBerry, how I've been able to manage that trade for about 7 times the amount that I've risked so far, how it's still going, how I'm continuing to manage this trade, and how we even found this trade in the first place. Hi everybody. My name is Michael Lamont. I'm the founder of ChartYourTrade.com, and our goal is to inspire millions of hardworking people just like you to take advantage of the stock market. And the way that we do that is by sharing all the little things that have helped me be able to take advantage of the stock market while working a full-time job, while having a family, and while having a 2.5-year-old daughter. So sit tight and I'll walk you through this trade. BlackBerry is a stock that we initially highlighted in the December 16th issue of our Elite Stock Setups report. Now, let's take a look at what it was doing back then. Back then, it was setting up right ahead of earnings. The way that it came onto our radar was it had these incredible estimates, and it had run nearly 100% in a very short period of time between April and towards the end of June. It had nearly run 100%. Now that not every stock is going to do something like that, and the volume and the price action and just the space itself and those estimates, it's all those factors that are getting weighed into something that's going to show up on our screens and on our radar. My partner, Adam Sarhan, saw this setup, decided to put it into the Elite Stocks Setups report, and this is some of the detail of what we saw setting up right ahead of earnings. Now, the opportunity to get in ahead of earnings was right back here, right? As it started to break out above this descending trend line, you had the opportunity to get in right ahead and participate in that gap up there. I didn't actually trade this trade back then, but because it was on the radar back in mid-December, I kept it on a watch list, and because it had that kind of explosive move after earnings, I wanted to keep it on the radar so that way, in case if it started to set up again, I would be able to participate in a swing trade. So breaks out, gaps up, and then starts to consolidate, and we could see the volume. And here, let me make this chart bigger. We could see the volume dry up as it's pulling back in, and it's pulling back into this support zone, right? So as it's pulling back in, I'm looking to see where is it catching support, and when it does catch support, well, what sort of factors are we looking at from a technical perspective, right? So when it broke below this here, right? So I'm looking at, so when a stock gaps up, the first place that I'm looking for it to catch support would be right at the low of the gap up, right? So that didn't happen here. So the next stop that I'm looking at is the 5-day exponential moving average, then the 10-day. And I'm basically looking at the moving averages because those are the next potential spots where maybe it catches support. So didn't catch support at the 5-day, that's this line here. Then it starts to maybe catch support at the 10-day, but not really. But there's a former resistance level right over here, and that's where it starts to catch support, and that 21-day exponential moving average is catching up to it as well. So back here, and last Thursday on YouTube, I had a YouTube live session where I was saying that this would make a pretty good entry point, like right around here, right at 11.40. So I actually entered this trade at $11.45, and the stop loss was right down here right at $11.15. I didn't know that that was before this day even happened, December 29th. I believe we recorded on December 28th. I've got to go back and look, but I'm pretty sure that that's that Thursday. And the reason why I picked 11.15 was because it was right around that that support level, right? So giving this day over here a little bit more breathing room if we were to break out. The low of this day back here was $11.20. So you don't want to be like right on top of the support level. You want to give it a little bit of room. So if it broke out, I would have been in, and I would have that little bit of breathing room for that trade. Also, you don't want to buy right at the high of the breakout. You want to give it a little bit more space so that way it's proving itself. Normally I would give it 10 cents. It depends really on the price of the stock, how much space you want to give it. So because this is a relatively lower price stock, I gave it 5 cents above the high. So I was using 11.40 as my entry point, right? So, or I was looking at a break above 11.40 as where it would start to trend higher. So I said, okay, 5 cents above that, $11.45 would be my entry point, and that's why I got in over there. And I was using $11.15 as my stop because I was initially using this as my low. So when it came down and it didn't break 11.15, I knew that I was able to still keep my stop there, and that would still be a valid point. If BlackBerry had broken below 11.15 on this day, then I would need to reset my stop. And for the plan, I wasn't in BlackBerry at that point. Once I'm in a trade, I'm never lowering my stops. I'm only raising my stops progressively in the trade. So BlackBerry breaks out, and it has a phenomenal first day breakout, right? And so in this one day, and remember, I'm only risking 30 cents on per share on this trade. And so with that, I'm able to have such a large position. And actually, let me show you how I calculate the position size. So I just come over here to ChartYourTrade, and I open up the tools, and I pull out the position size calculator. And what I'll do is I'll enter the size of my account, right? So let's say I'm working with a relatively small account, right? Let's just use $10,000 as a nice round number, right? So 10,000, right? You could be trading well with a much smaller account. If you have $1,000, this works as well. But let's just use 10,000 for now. We could always adjust this too. I always like to risk 1% of my trading capital. The reason why I only want to risk 1% of my trading capital is because that tends to be the sweet spot of not risking too much on a trade and risking just enough. So if this trade turns into a loser, I'm only risking 1% of my capital. If it turns out to be a winner, and most of my winners tend to be in the neighborhood of 2 to 3 times the amount that I've risked, then I'm making 2 to 3% of my portfolio on this one trade. And those trades tend to work out within a couple of weeks or maybe a month or so. So compounded over time, just for one trade, that really helps your portfolio ramp up pretty quickly. So entry point is 11.45, stop is 11.15, and let's compute. So we could see that on this particular trade, it would be 333 shares. The position size is $3,816, so about 38% of my portfolio was initially weighted into BlackBerry. So that in itself looks like a pretty heavy weighting, but I'm only risking 1% of my trading capital. So of that 10,000, I'm only risking $100, and between my entry point and my exit point, it's only 2.62%. So very, very little risk for a potentially high reward. And so again, let's say you only had $1,000, right? Click compute, you'd be buying 33 shares, you'd only be risking $10 on this trade. So if you're somebody that is watching this and you are just starting out, if you have an account with someone, with a broker like Robinhood that doesn't charge you to trade, then doing something like this or starting to learn how to swing trade makes a whole lot of sense, because you don't have to worry about the transaction fees of $5 or $10 or even $2 with some brokers. Your transaction fees are for free, and so you can trade with a tiny account of only $1,000 and be able to effectively trade a relatively lower price stock like a BlackBerry. But anyway, let's get back to BlackBerry. So it broke out here and it hit $12, right? It closed right at 12.02, right below 2 times the amount that I initially risked. Now, I like to start to peel off bits and pieces of a position once I've made between 2 to 3 times the amount that I've risked. So because it finished at the top of the range and it broke out on heavy volume, I decided that I wouldn't sell right there. I would wait until the following day, but I was also moving my stops up at that point. I believe I moved half my stop up to break even while keeping the remaining stop down at the original stop level. Right, so the following day, BlackBerry gapped up and I began to scale out of the position a little bit. I sold about a little under 20% of my trade that morning, and I tweeted about it, posted it on Instagram. If you're not already following me on those channels, also on Facebook, if you're not following me there, I'll link it in the description, and you can go and follow me on those places as well. So I sold a bit there, and then at the end of the trading day, I sold a little bit more. All right, so at this point, I had sold about 30% total of my initial position, and towards the end of the day on, what is that? That's Wednesday, January 3rd, we are already looking at what's close to a 7R trade. So to go back to that $10,000 and risking $100 initially, to make 7 times that, so I made 7% for my portfolio in only 2 days, right? So if we were to compound that over a year, that's one hell of a year, right? But understanding too that is extremely rare. Most trades don't work this quickly, this fast, so we don't want to just hang on to everything and hope that it's going to keep on going higher. We want to recognize that this is an anomaly and scale out bits and pieces, so that way we're not selling the whole thing, because if it does go to the moon, then we'll feel terrible and we would have missed out on the rest of that upside. And you could argue which is worse, missing out on the actual upside or how it's going to feel for us emotionally, because when we start to lose mental capital, that's when we start to make more bad decisions. And I would rather miss out on additional upside than make poor decisions that's going to affect the rest of my portfolio. So there's a lot to the mental side of trading. We have a whole bunch of videos about that. I'll link them somewhere up here and also have those linked in the description as well. But so I'm scaling out of the position starting on this day. Then over here on the 4th, I should have sold when we hit 14. I should have started scaling out a little bit more at that level. I had 9 times the amount that I've risked. And so every time we go up another 2 to 3 R, I like to scale out a little bit more. So at the time, when I saw it gap up yesterday morning and hit right around 1350 and started to climb higher, I was telling myself, okay, I'll wait until the end of the day and then I'll make my decision. In hindsight, I think that I was being a little bit greedy on the trade, because from a risk management perspective, we want to begin scaling out as we're hitting progressively higher multiples of our risk, because we could see it pull back on us, right? Like there's no guarantee that we'll get back up to that level. So scale out a little bit, let the rest continue to ride. I didn't do that on this trade, but I did decide to exit a bit more near the close and got out right around $13.40. I think I actually exited at $13.39. So locking in about 6.5 R on that portion of it. And now I'm down to about 60% of my original position. I moved my stop losses up to right below the low of this day here, so right around 13.10, and then right below the low of this gap up over here, so right around 12.45, and we also have the 5-day exponential moving average protecting that as well. So this stop over here should be pretty safe given the protection. I'm not worried about getting shaken out over here, and if I am shaken out, then I should be closing the position, and that would be locking in about a 4R on that portion of the position. And if I get shaken out over here, that would be locking down about 5R, a little bit more than 5R on that part of the position. And overall, I'm looking at about a 6 to 7 R trade on this if I'm stopped out. If BlackBerry continues to run, then it could end up being much, much higher. But one point that I want to make is that I really like to sell into strength for those reasons. If you're not selling into strength, then by definition, you're selling on weakness. And so as we scale out of a position, it's not only allowing us to participate in further upside, but it's also building up that mental capital and that confidence, and also getting us into a selling mood. We don't want to, and I keep on going back to this book over here, but one of the stories that Bill O'Neill shares in How to Make Money in Stocks is this story about a guy who sets up a trap to capture turkeys, right? Like one of these old school traps with a little box and a string, and putting bird seed into the bottom of this box. And the guy's sitting behind a tree, and the turkeys are coming by, and they start to eat the bird seed. So he has one in there, he has two, eventually 10 or so get under the box, and he doesn't pull the string. And the reason why he doesn't pull the string is because he feels that, oh, there might be some more turkeys that come by, and I don't want to miss out on getting more turkeys underneath the box. So eventually the first turkey has his fill, leaves. Okay, so now I'm down to 9. I'll wait until that turkey comes back. Then eventually another turkey leaves, then another turkey and another turkey, then before you know it, all the turkeys have left, and he never pulled the string. The point is that we need to pull the string, right? We need to lock in some of our gains, but in trading, it's not an all or nothing decision. We can scale out on the way up or on the way down. We don't need to just pull the string and lock in everything all at once. And that's the purpose of that story. That's my big takeaway from it. And so moving forward on this BlackBerry trade, and I'll update you again once the entire trade is closed, but for right now, if we do get above 14 again, I will be scaling out of a bit more of my position. I'll be taking off another 20% of the original position, so I'll be left with 40%, and then I will maintain my stops where they are for now, so split evenly, so 20% on a break below this one and a 20% below a break on that one down there, and that'll be it. And I'll continuously update my plan for this trade, and I'm updating it at night and near the close, so I'm not just sitting here watching BlackBerry all day long. This is something that I'm spending a lot more time explaining to you my thoughts and rationale behind the trade, but in real time, it's taking me maybe 5 minutes, maybe even less than 5 minutes to see what BlackBerry is doing and come up with a decision of, okay, here's what I'm going to do and how I'm going to do it, and jotting down my rationale. So that's it. I hope that you found this helpful. If you did, give this video a thumbs up. That really helps us out quite a bit. And also subscribe to the channel and make sure that you're getting all of our updates. Thanks again for watching. I truly appreciate it. Thank you so much for your time, and I will see you again in the next video. Take care and have a great day.